Hey everyone, quick update. Because gold just slipped by about 32 bucks and it's sitting around 5,051 an ounce right now. And the reason this matters is simple. That $5,000 area isn't just a random number. It's one of those psychological lines in the sand where big money tends to react and where headlines start changing the mood fast. When gold is comfortably above it, everyone talks like the rally is inevitable. When gold dips back toward it, suddenly you start hearing the word top. So today I want to walk you through what this move could actually mean, why it happened, and what I'm watching next. Because whether this is just a normal shakeout or the start of a deeper pullback usually becomes obvious in the next window, not months from now. Now, we're not looking at typical volatility here. Let me show you the three things happening right now that make this drop more important than it looks. First, gold didn't just drift lower. This was a clean, noticeable push down, while the market is still deciding what the Federal Reserve is going to do next. And I want you to think about how markets behave when they're uncertain about rates. If traders believe rates stay tight for longer, that usually props up cash and short-term yields. And when yields look attractive, gold often gets treated like the asset you can postpone owning. Not because gold is bad, but because gold doesn't pay interest. So in the short run, when the market's thinking higher for longer, gold can get hit on these sudden air pockets. Second, the way this move happened matters. A $30 drop in gold sounds normal to people who've watched this market for years. But when it happens around a big round number level, like 5,000, it becomes a decision point. This is where traders start making binary bets. You get the short-term crowd saying, if 5,000 breaks, this rolls over hard. You get the long-term crowd saying, if 5,000 holds, this is a gift. And that tug of war is exactly why the next handful of sessions can be more important than the entire last month. Third, the most misunderstood part, gold can drop even when the long-term story is still bullish. I know that sounds contradictory, but it's the truth. Gold can have an incredibly strong macro narrative, central banks buying, geopolitical uncertainty, currency questions, and still get slammed for a few days because positioning gets crowded, because traders are overlevered, or because the market suddenly reprices the path of rates. That's why the move today isn't proof of anything by itself, but it is a signal. It's a signal that the market is testing conviction right at a key level, and it's trying to shake out whoever is weakest before the next leg. Now let's stack the evidence, because when you put the pieces together, you get a much clearer picture of what's actually going on. Smart money moved before the crowd noticed, and one of the most important tells in a gold market like this is what happens outside the US. Especially in places where buying is more about reserves and long-term stability than about day-to-day speculation. China is a big part of that story. Here's what I'm watching: official buying behavior and ETF behavior. When you see consistent official sector accumulation, it tells you someone is thinking in multi-year terms. It's not a trade, it's not a quick flip. It's a strategic decision about what belongs on a balance sheet when the world is uncertain. And at the same time, when you see strong ETF activity, that tells you something else. The local investor base is not treating gold like a museum piece. They're treating it like a real financial instrument, a place to park value and manage risk. Now, zoom out with me for a second. A market can be structurally bullish and still have violent pullbacks. In fact, the more bullish the long-term story gets, the more violent the pullbacks can become, because more traders start believing it can't go down. And that's when the market punishes complacency. That's why I'm not shocked by a $30 hit. What I'm focused on is the message of where it's happening, right around a level that has become a global reference point. And that brings me to the technical reality, without you needing to see a single chart. When a market runs hard, it builds what I call air pockets. These are zones where price moves so fast that not many real buyers got comfortable stepping in. So when you revisit those zones, price can fall quickly because it's basically searching for the next area where real demand is willing to absorb selling. 5,000 is one of those areas where demand should show up, if this is still a strong uptrend. So here's the simple framework I'm using. If gold can stabilize, hold that zone, and start reclaiming the mid-5,000 area quickly, then today's move starts looking like a shakeout, an emotional flush that hands supply from weak holders to stronger hands. But if gold keeps slipping, and we start seeing it accept prices below 5,000, meaning it stays there, not just dips there, then you're looking at a different phase. That becomes a regime check, where the market is asking, are we repricing the whole move? And if that happens, the pullback can feel a lot bigger than anyone expects because sentiment flips fast. Now I want to talk about the Fed angle in plain English, because this is where most people get trapped. When people hear tight policy, they think, okay, gold down. But it's not that simple. Gold doesn't just react to the level of rates. It reacts to the direction of surprise. If the market expects rate cuts and doesn't get them, gold can sell off. If the market expects rates to stay tight and then suddenly gets a softer tone, gold can rip higher. So the key isn't what rates are, it's what the market thought they would be, versus what new information forces them to become. That's why gold can drop on days where the long-term story still looks bullish. It's the short-term expectations getting repriced. Now let's go historical for a minute, because this is where your brain gets the pattern. We've seen this exact pattern before. Think back to 2020. You had fear, uncertainty, massive policy shifts, and a global scramble for safety. Gold surged, and then it didn't move in a straight line. It had gut-check pullbacks that convinced people the run was over, right before it pushed higher again. And here's the psychology that repeats. When gold is strong, people start buying because they feel smart. When gold dips hard, people start selling because they feel stupid. That's the cycle, and the market exploits it. In those big moments, gold often behaves like this. It runs up, everyone gets bullish. Then it pulls back, and suddenly the narratives flip. People start calling it a blow-off top, even when nothing structural has changed. Then it stabilizes, quietly. And when the crowd gets bored or shaken out, it moves again. Now, does history repeat perfectly? No. But the sequence of human behavior repeats constantly. And that's what you're really trading against. Not numbers, not headlines. Human emotion. So here's where I think we are today. We're in that conviction test moment. Not at the beginning of the story and not at the end. A conviction test is where the market asks, who owns this for the right reasons? And who owns this because they were chasing? If you were chasing, today hurts. If you were positioned thoughtfully, today is just information. Now let's make this personal, because if you're watching this, you're not watching it for entertainment. You're watching it because this affects your money directly. Let me give you two simple real-life examples. Example 1, you're holding some gold exposure, maybe physical, maybe a fund, maybe miners, maybe a diversified basket. When gold drops about $32 an ounce, that doesn't sound like much until you translate it into the real units you actually own. If you own 10 ounces, that's roughly $320 of movement in a day. If you own 50 ounces across a family plan or long-term accumulation, that's about $1,600. And if you're using a product with leverage, or you're in miners that amplify the move, it can feel like someone turned the volume knob up to max. Example 2. Even if you don't own gold, gold is telling you something about the system. Gold is the market's lie detector. Not day to day, not tick to tick. But over time, gold reflects how confident people are that the purchasing power of their currency will hold up, and whether the safe assets are actually safe. So when gold is hovering around a massive level like 5,000, and you see it wobble, you're seeing hesitation in the market's confidence. And that matters for everything else you own. Now, I want to be very clear and very honest. I don't know if 5,000 is the exact bottom of this dip. Nobody knows that. We could dip further first, that's always possible, but here's what I do know. I do. The window you should care about isn't the next 5 minutes. It's the next stretch of sessions where gold either holds this zone and starts rebuilding, or breaks it and forces a deeper reset. Because whichever one happens will set the tone for how people talk about gold for the next several months, and when the narrative changes, flows change. When flows change, price follows. Look, the question isn't whether we see more volatility. The math is clear. When markets are this sensitive to rates, to policy expectations, and to global reserve behavior, you're going to get sharp moves. The real question is, are you positioned for what comes next? In every previous regime shift, hard assets preserved purchasing power while paper promises eroded, sometimes slowly, sometimes suddenly. Right now, gold is around 5,051. That 5,000 line is the battlefield. And the next short window determines whether this was capitulation, meaning the last sellers got flushed, or whether it's the start of a deeper slide. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations, but the data tells the story. All right, before you go, 3 quick things. 1, drop a comment below. Tell me where you're watching from and where you think gold is headed by the end of the month. Are we back above 5,200 or are we fighting to hold 5,000? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video gave you value, comment data over hype so the algorithm knows you're here for the original. 3, next video drops soon, and I'm covering the one indicator that tends to show up right before metals make their most emotional move. It's flashing again, and most people aren't watching it. You won't want to miss it. See you in the next one.